Today's lesson is all about investing basics for retirement savings, making your money grow. This is where we learn to unlock the true potential of how to make your money grow. You may recall that inflation chips away at the purchasing power of your cash over time. If your money just sits in a regular savings account, it's actually losing value. Your money needs to do more than just sit still. It needs to grow. And the most effective way to make that happen is through investing. Let's talk about something important for your future. Inflation. Don't let the word scare you. It's simply the steady increase in price over time. What it means for you is that your money today will buy less in the future. It's a silent force that erodes the value of your cash. For an example, an item that cost $10 in 1990 will cost around $25 in 2025. That's more than double. The average inflation rate between those years has been around 2.8%. This shows us why investing is crucial, not just saving cash. It's more. When your money sits as cash, it loses buying power due to inflation. But when you invest, your money has the potential to grow, earning returns that can outpace this silent threat. So, what does this mean to invest? Well, it's actually a straightforward concept. Investing is the act of putting your money into assets, things like stocks and bonds, with the expectation that they will increase in value for you over time. It's about putting your money to work for you. Let's dive into the first major player, stocks. When you buy a stock, you're buying a small piece of a company. We call it a share. For example, if you buy a share of your favorite company, you become a part owner. If that company performs well, perhaps they launch a successful new product or expand their market, the value of your share, your stock, will go up. The increase in value is called capital appreciation. Additionally, some profitable companies will share their earnings with the owners by paying out dividends. Now, it's important to note stocks offer the highest potential return for your money, meaning they can grow rapidly. However, because companies can have ups and downs, they can also come with higher risk. If the company struggles, the stock price will decline. On the other side of the coin, we have bonds. When you buy a bond, you're essentially lending money to a government or to a corporation. Imagine it's like giving a formal loan. In return for your loan, they promise to pay you back the original amount you lent by a specific date, known as the maturity date, and they make regular interest payments to you along the way. Generally speaking, bonds are considered less risky than stocks. Governments and established corporations are typically reliable about fulfilling their debt obligations. Because of this added safety, bonds are usually offered as a lower potential returns compared to stocks. They are more about providing stability and steady income rather than aggressive growth. Now, researching and picking individual stocks or bonds can be incredibly daunting and time-consuming. That's where mutual funds and exchange-traded funds, commonly known as ETFs, come into play. Instead of needing to individually select and buy dozens of stocks or bonds, you can simply buy a share of a fund that already owns a diverse collection of many different stocks, bonds, and other assets. It's like purchasing a pre-assembled investment basket. Mutual funds are typically bought and sold based on their net asset value at the end of the trading day, where ETFs, exchange traded funds, on the other hand, trade just like individual stocks throughout the day on the stock exchange. The key takeaway here is that both make investing in a wide variety of assets incredibly accessible and easy. The benefits of using these funds are truly significant. First and foremost, they provide instant diversification. These funds essentially handle the heavy lifting of spreading out your investments for you. Many funds also offer professional management, or they are designed to track a broad market index like the S&P 500, giving you broad market exposures. They represent a remarkably simple way to build a robust portfolio without requiring you to become a financial expert overnight. And passively managed index funds often come with very low fees, which means more of your money stays invested and continues to grow for you. For young adults, there's a simple option called target date funds. These are a specialized type of mutual fund or ETF created specifically for retirement savers in mind. Here's how they work. You choose a fund based on your target retirement date. For example, 2070 fund. The brilliant part is that the fund automatically adjusts its mix of stocks and bonds over time. Like when you're younger and the retirement is far off, the fund holds a more aggressive allocation, primarily invested in stocks for maximum growth. As your target retirement date draws closer, it gradually becomes more conservative, shifting towards a higher allocation of bonds to protect your accumulated capital. It's essentially like having an autopilot system for your retirement investment. Truly set it and forget it, while still being smart and strategic about your long-term goals. Let's talk about a fundamental principle in investing, the relationship between risk and potential returns. We call it a balancing act. It's a core truth that a higher potential return usually means higher risk, which implies more volatility and a greater potential for short-term losses. Conversely, lower potential return usually means lower risk, offering more stability and predictability. Think of a standard savings account. That's very low risk, but it also provides very low returns. Now compare that to investing in a mutual fund, investing primarily in stocks, potentially very high returns, but also a higher risk. Investing is about finding this right balance that suits your individual comfort level and goals, and we will discuss that in future lessons. And this brings us to the advantages that young adults possess, and that's your time horizon. As a young adult saving for retirement, you likely have years until you actually need to access that money. This means you have a long time horizon, so you can afford to take more risk, meaning you can invest more heavily in stocks, focus type funds or ETFs. If the market experiences a downturn next year or 5 years from now, you have decades for it to recover and continue growing. Short-term market fluctuations become far less concerning when you have such a long runway ahead of you, allowing your investments to capture those higher potential returns over the long haul. For example, the average S&P equity fund index since 1957 is around 10% a year. Let's discuss one of the most critical rules in all of investing, diversification. You may recall the saying, don't put all your eggs in one basket. In investing, this means strategically spreading your investments across different investment types and different asset classes, like mixing both stocks and bonds. Why is this so crucial? Because if one particular industry performs poorly, it won't have a devastating impact on your entire portfolio. Diversification significantly reduces the overall risk and impact on your portfolio if any single investment performs poorly. Remember how we talked about mutual funds and ETFs. They are truly fantastic tools for achieving instant, broad diversification with minimum efforts on your part. To summarize, investing is absolutely fundamental for retirement. It is the engine that helps your money outpace inflation and truly grow over time. Now you understand the difference between stocks, high growth potential with higher risk, and bonds, lower growth but greater stability. And funds like mutual funds and ETFs are effective to help your money grow while giving you more opportunity for diversification. Remember that diversification is key to managing risk, giving you an advantage to invest for the strong long-term growth. I'd like you to follow up on a task here. If you currently have a retirement account like a 401k through an employer, or you started your own Roth IRA account that you set up yourself, I encourage you to log in and take a look at the investment options available to you. Specifically, try to find and identify the target date funds that align with your expected retirement year, and also become familiar with these options and any other options that are offered to you.